Hey guys, welcome back. In this video, I want us to discuss the latest growth stock that I bought into earlier this month. So, I don't know if this has happened to you before, but you buy into something and it just starts to skyrocket. Well, that's what's going on with this stock. It just won't stop going up. And I know it sounds weird, but it's making me have to take really hard decisions about the stock. I'll tell you all about it in the video. But first, remember earlier this month, especially on October 4th, which was a Monday 2 weeks ago, how everyone was capitulating on the stock market. Everyone was so negative and talking about the stock market was going to crash, and you had the debt ceiling and Evergrande, the Chinese real estate thing. Right? And everyone was really blowing this out of proportion, in my opinion. So this was a great time to actually buy, and that's what I did. Let me show you. Right on the SPY, you can clearly see that the stock market had been in a small downtrend, no doubt about that. And on October 4th, look at the big red candles. So since then, we've had a tremendous rebound over the past 2 weeks, and now everyone is in FOMO mode again. Well, on October 4th, I sold some options, did really well with those, but I also bought into one of the big growth stocks, which I sent an alert on Discord, of course, and it is Enphase. Now, for those of you that are interested in the three pillars of my investing strategy, which is buying high quality stocks, selling options, and real estate, look at the link in the description for the Discord and Patreon. You'll probably really enjoy it, and you will get the alerts whenever I buy or sell something. But when I did this one, right, I bought into Enphase, and what I did is I buy right on Enphase. A buy right is when you buy shares, and at the same time you sell a covered call. I don't know if you can figure out why that is a problem. Covered calls are great when the stock moves up slowly or is sideways or comes down slowly, but it's not really good when the stock is skyrocketing like Enphase is right now. So I just want us to look at Enphase. Why is it such a great stock, and why you should probably keep it on your watch list, right? And if it comes down after the earnings, you may want to seriously consider this one because, as you can see, it has a ton of momentum currently. So let's start with the obvious. Let's go over what my thesis was, and then we'll expand from there. So what I was saying is Enphase is another growth stock that has been crushed in the past few months after reaching a 52-week high of 229, and the low was $92. So when I bought into it, when it was around 145, we were much closer to the 52-week low. But still has room to go down, which is why I'm hedging this with a covered call at 150. That's the mistake that I did in this position. The company is the only real game in town when it comes to high quality microinverters for solar. The company is already profitable and it's expanding into other countries. So if you believe in solar, then you believe Enphase has room to grow. The question is how much growth is already priced in, which is a lot since it's a hyper growth stock and everyone knows it. So this gave me a cost basis of $135. Now, I still fully agree with this, right? The only thing is that since I bought it when the stock market was going down, I should not have put the covered call on it. So this is why I'm going to have to work really, really hard to adjust the position over the next few months. I'll show you later in the video. So why is the stock actually soaring like it is right now? Well, it's pretty easy. The cost of energy is skyrocketing. You guys probably have felt it when you go to the gas pump. I don't know about you, but right now in Virginia, it went up to above $3. I know for you, like in Hawaii or California, it's probably like $5 or $6. Well, it is a lot more expensive than it was like last year. And what that does is when coal, gas, electricity in general goes up, it makes solar power look cheaper. It's that simple, right? If you're a door-to-door salesman for solar panels and you go to someone's house and they were paying like $150 or $200 per month, honestly, a lot of them don't really care. They don't want to put a $40,000 system on their roof. I know because I've tried it. So now if you go to the same house and a year later they're paying $300, then they're going to see like the massive rising cost and how, the solar power could be a cheaper alternative. So comparatively, it makes solar look cheaper, and that's going to increase their demand both for residential and commercial customers. So Enphase has some competitors, right? So one of them is SolarEdge, but in general, it is considered the best company when it comes to microinverters, which is what is used to convert the power from the solar panels to what you're using in your house. All right, so currently the stock is at 25 billion. It is fairly high, right? But notice how they keep announcing new expansions, and that is why, like, that's just propping up the stock. Everything is coming in at the same time, and for some reason people are rediscovering the stock. So they just announced that they're launching their battery system in Belgium. They are expanding in Italy, if I can find it. Yeah, they're launching their new products in Italy. They're launching their new products in Brazil. So the company is expanding worldwide now. And what is that going to do to the revenues, right? Obviously, the revenues are going to be going up in the next few months, next few years, as they really expand into new markets. Think about how Europe right now has such big energy problems. Europe is already like a little bit ahead of North America when it comes to going green, but they're super dependent on Russia, for example. While going with more solar energy is one way to limit their exposure and limit their weaknesses when it comes to being energy dependent on other countries, rather. Sorry. When you look at the company's earnings, you're going to understand why the company is in such a position of strength right now, which makes it very interesting why it actually went down so much in the previous quarter. Because the company is generating 316 million in revenues, 40.4% gross margin, which is improving from last year where they were at 38.5. So that's going to be very good for improving the free cash flow. The company is profitable, and believe it or not, I'm not even joking. Like, I'm telling you something that you might have never heard on YouTube before. Profits actually matter. It makes companies' share price go higher, right, when Wall Street really gets behind these companies. So look at how just quarter over quarter, Q1 versus Q2 in 2021, they actually went from 301 million in revenues to 316 million, which is a 5% increase. Not a ton, right? But they are facing the same supply constraints that everyone else has. In fact, they mention here that the demand currently is much higher than the supply. So what they're doing is they have new suppliers coming online in Q4 and I believe in Q1 of 2022. So that means that they're going to get more supplies and they're going to be able to deliver more of these microinverters. Again, the revenues are going to go higher because of that, and possibly also their margin is going to get better. Now, the company is having their new earnings call on October 26th, so about 10 days from when I'm filming this, and this is going to give us an update on the company's numbers. It is very, very possible that just like we saw in previous quarters, there is a run-up towards the earnings, and then after the earnings the share price goes down. That would actually be very good for myself, for my covered calls, and for other people that want to actually get into the stock. Because right now, when it's going up $10 per day, it makes it very, very difficult to analyze the stock properly, and that's why a lot of people are going to have FOMO. Now, if you look at the expectations that the analysts have, you're going to understand why I'm so enthusiastic about this stock. I have been for a long time, but I never got into it before this because the price was too high. Well, the analysts expect that for this year they have 1.34 billion in revenues, and next year 1.81 billion, right? So we go for 35.5% next year, and it's very, very likely that they're going to exceed that. When you have companies like these that are not startups, that are getting over 30%, 35%, 40% growth year after year for the next several years, that's when, yes, the P ratio is very high, but there's a good reason for that. Everyone knows that the company is in hyper growth mode currently. So I don't have a big problem with that. Especially for companies like these that are already profitable, where the analysts expect 1.37 in EPS this year and 2.13 next year. Now, why does that matter? Well, in some cases, it is okay to pay up for quality. This is a very high quality stock. I know it's good, you know it's good, Wall Street knows it's good, and for that reason, knowing that the company will have that growth for the next several years, the multiples are higher. There's nothing wrong with that. I wouldn't do that with my entire portfolio, right? But in cases like these, where we all know the business model is solid, right? A good comparison would be Palantir. Why is Palantir so expensive? It's because everyone knows that the business model is solid and the company will continue to grow in the next few years. Well, it's the same one with this one. So it's not a matter of should you like get into it? It's a matter of at what price does it make sense to get into it. Now, let's take a quick look at the analyst ratings for this stock. We are getting very, very close to like the upper bracket. As you can see, a lot of the price targets 200, 179, 157, 238, 202, and 202. These are the ones in the past few months. So at $188 currently, we're reaching towards the top of that bracket, and now it's all going to be about the earnings that are coming up on October 26th. And also the expansion plans, right? Are they going to be expanding faster than we expected and that the analysts expected? Before I wrap up the video, let me show you the chart with the supports, resistances, and then my position. So first, notice how we are getting very close to the $190 resistance right here, which was from this summer, the Q2 earnings. Now we're getting very close to that. I'm not sure if we'll be able to get through it. If we do, the next resistance is going to be around 210, 220. Now, what would it take for the company to get closer to those levels and the 52-week high? Well, it's going to need a very strong Q3 earnings result, and then they'll continue to announce like expansion plans in South America and Europe, and then it's also going to need energy prices to continue going up. If all of that happens, then yeah, it might go above 190. But personally, if I had to put money on it, I think that the stock is probably going to sell off like at the earnings and go back down. Now, where is it going to go back down? Of course, that is the difficult question. One of the supports is going to be at 145 where I bought, and then after that, or rather before that, you got about 120 right here. And so, are they going to go down to 120? I don't expect that it will, but I would not be surprised if it went back down to 150. This is a very volatile stock. And that's both good and bad, right? You get those huge spikes, but you're also going to get those big crashes. Now, that's actually not a bad thing. I would not be disappointed if it goes down to 150 because, like, I only bought 100 shares. If I could rewind time before the expansion announcements in Europe and in Brazil, I would have bought 200 shares, like $30,000 worth, right? So that is kind of what I'm hoping is going to happen. Then I would probably increase my position a little bit, because I do believe in the stock long term. So these are my positions, right? So I have 100 shares I bought at 145. On the shares, I'm up $4,300 in 2 weeks. But on the covered call, though, that is the negative thing. It is a big hedge. If the share price drops, I'm not going to lose any money, right? The covered call is going to hedge my position and actually expires on November 5th. After the earnings, so I have a lot of time still, but for now I'm down $3,000 on the covered calls, so it's very possible that I will need to adjust if I want to keep the shares. How would I do that? Well, I would have to actually like go out until January and raise the strike price from 150 to 160, and currently if you notice, there's a big spread between the ask and the bid. So I would probably be able to get something in the 275 range, which is the average right now. Meaning that I would basically buy $10 worth of value for $2.75. Now, is that good or is that bad? Well, think about it. That means that I would only get $7.25 in value for 2 months. Right, so it's okay, but it's not like really amazing. So that's why I would prefer if the stock price dropped, so I could get a much better adjustment. I hope this helps you. Let me know in the comments if you're already in this stock and if you like it, if you're as enthusiastic as I am. Make sure to look at the Discord and the Patreon, especially if you're like me and you believe in those 3 pillars: buying very high quality stocks long term, selling options, and real estate. So I'll see you guys in the next video.